Hello, everyone, and welcome to today's webinar, The American Rescue Plan Act of 2021, What It Means to You. I'm Yonina F, Shineweather, CPA, the Consulting Director of Compliance at Viventium. And today we're going to be taking a look together at what on the surface seems to be not so complicated a piece of legislation. We have some credits that are getting extended, and that's good news for employers, that's welcome news. And we would first glance the ARPA, which is what we're calling the American Rescue Plan Act in the payroll world. ARPA seems to be deceptively simple, and I put the emphasis on deceptively because when we begin breaking it down and zooming in on the provisions, not only, in my opinion personally, is ARPA the most complex piece of COVID legislation so far, it's also the one that is hardest to comply with. And I know that sounds like a sweeping statement. I'm pretty sure that by the time we finish today's webinar, you'll actually agree with me. Let me first start with a couple of administrative points. I see some of you here today are asking. Today's webinar is being recorded. The recording will be available to you, including the slides. And the slides will be sent out to you after the presentation, not currently. I know some people were asking if they could have the slides now for annotating, but we're not going to be doing that. We do send the slides out to you afterwards. All of the highlights of what we're going to be talking about today are summarized on the slides, other than our question and answer, which is an important part of it, of course. But I do recommend maybe jotting down an outline for yourself, because I'm already going to tell you there is such a whopping amount of information to digest, and it starts to get so crazy, and I don't use that word lightly, in terms of what they did with deadlines and extensions. So we really are all going to have to put on our thinking caps and our accounting person caps, or payroll caps, and really comb this out carefully. So just in terms of the administrative part, yeah, you will be getting a copy of the recording and the slides. The webinar is being recorded. Now, I briefly mentioned question and answers. I see so many familiar names back, and I want to welcome people who have done webinars with Viventium and with me at Viventium in the past. I think I always say, please ask your questions as we go along. This is meant to be as interactive as possible. My goal is for each of our participants, and I know there are a lot of you today, to come away from here understanding, if not 100%, but from 95% and up, what this law means to each of you. And so I really want you to ask questions as I go along. And I do keep my eye on those questions. I will try to address them as I go along. If there's something that's not clear to you, or something you feel is not being explained thoroughly enough, then there are probably at least 10 other people on the call who are feeling the same thing. So you'll be doing both yourself and a lot of others a favor by asking. And I'm not sure if we're going to actually have time at the end for a Q&A session, because there's just so much we need to cover, but I will at least try to address the questions as we go along. One last administrative point, I want to request that when you do exit the webinar, there'll be a brief single question survey for you to fill out. And I'd like to request, if you can do that, that is a help to us at Viventium. Okay, so ARPA. So where are we up to in the legislative scorecard? Well, we had back in March of 2020, the Families First Coronavirus Response Act, otherwise known as the FFCRA, or as we like to call it at Viventium, FFCRA. And that was the beginning of COVID relief legislation. That introduced us to the idea of mandatory paid time off for people suffering from various implications and impact of COVID. And that mandatory time off, although it was seemingly paid by the employer, it really wasn't. It was really being paid by the federal government, because the amounts that you paid, you got back as credits against your payroll taxes. Now, this is not new. We all know this already. I'm just reviewing it because when we start hearing the changes, and that's one of the things that makes ARPA so hard, we have to start saying, oh, wait, what was the original law? What was it originally? So I'm just trying to place it in history right now. So that was FFCRA. And then on March 27th, 2020, Congress passed the CARES Act, C-A-R-E-S, right? And that introduced us to some changes to FFCRA, but mainly it introduced us to the employee retention credit for keeping employees on payroll, and the Paycheck Protection Program, the PPP forgivable loan program of SBA. Later on in the year, we had the PPP FA, the Flexibility Act for the PPP, which expanded, which gave us the 8 or the 24 covered weeks and some other flexibilities and extensions. And then we had, well, as part of a presidential memorandum that wasn't actually a law, but it was an executive order or executive memorandum that was signed, employees were now being permitted to defer 4 months worth of their Social Security payments. Very few employers opted into that. The CARES Act, I forgot to mention, also created an employer Social Security deferral. That was back in March, where employers were able to defer their Social Security and pay it back in 2 installments, one at the end of 2020, one at the end of 2021. So that was what the presidential executive memorandum did, was say that employees can also defer depositing their Social Security taxes if they want to, but they're going to have to pay it back within the first 4 months of 2021. So most employers did not opt into that because they said, well, what if my employer gets terminated, or what if I'm high turnover? I'm going to have to be left holding the bag and pay back that Social Security, so I'm not going to do that, and it's just too much administrative work, so most people didn't do that. Then on December 27th, 2020, former President Trump signed the Consolidated Reconciliation Act, and that was basically the budget, and that contained many extensions. It extended the FFCRA credits, the paid leave credits, for another quarter till the first quarter of 2021. It extended the employee retention credit until the second quarter of 2021. It allowed employees to pay back their Social Security over the whole 2021 instead of just in the first 4 months. And it created a second round of PPP, opened the program up again for loans. People were able to take first draw loans if they hadn't taken them before, and second draw loans if they had taken them and used up all the funds. And that was really where we were up to. And I'm not even talking about the stimulus payments. We're just focusing on payroll here. That was really we were up to when Congress once again passed new legislation called the ARPA. And it sounds like we're just extending credits, but now we're going to start taking a look at ARPA, and we're going to see really how you need to so thoroughly understand all the legislation that went on before in order to really appreciate what's going on and to comply with ARPA. Now, all that said, I just want to put in a little disclaimer that Viventium is not engaged in the practice of providing legal, accounting, or tax advice. We are not an SBA authorized lender, nor do we take any position on providing advice with respect to guidance from SBA and otherwise. And we do encourage you to always consult with your tax advisors or your benefit consultants before making any decisions regarding your payroll or HR practices. I can't begin talking about ARPA without doing a nod in the direction of some very high profile non-payroll provisions. And yet what we're going to see is payroll touches almost anywhere. So some of these supposedly non-payroll provisions are actually going to create work for us as payroll professionals. Let's take a look at what they are. First, we have the direct stimulus payment. I think that was the most high profile coverage during this entire discussion about the new legislation. These direct stimulus payments, some of you may already be seeing them in your bank accounts, $1,400. That was really, I think, what most Americans, were focused on in the legislation. We as employers, of course, are always saying, well, what's the employment angle here? I haven't been able to find any employment angle as of the direct stimulus payments, but some of these other provisions will. There was an expansion of the child tax credit. Pre-ARPA, qualifying dependents, which were dependents up till age 17, qualified their parents, claimed them to get back a tax credit of $2,000 per child. Now, if you had taxes that were more than $2,000, you just offset $2,000 against your tax. If you didn't pay tax or you had lower taxes, you couldn't get the full $2,000. You could only get $1,200 back. And that would be, I'm sorry, $1,400 back. I have so many different numbers in my head. And that would be, what you would get for each child, $1,400. not the full 2,000, so 1,400 of it was refundable, and the remaining 600 was only if you had tax. That has now been expanded by ARPA, and for each child, you'll get at least $3,000. For children under age 6, $3,600. This is just for 2021 right now. And you'll be able to also claim children up to age 18. In other words, the 17-year-olds, well, you have an extra $3,000 coming to you. That's because ARPA extended that age till 18. In other words, children who are 17 also are going to qualify their parents. Now, what does this have to do with payroll? Well, if you think about it, it does. Form W-4 is going to have to change, and the IRS is going to be issuing a new Form W-4. The IRS is going to be issuing a whole laundry list of new forms, but they're going to have to do a new Form W-4. Anybody can think of why? So we're at class, I'd ask you to raise your hand. If you take a look at Form W-4, part of what employees can claim on their W-4 is how much child tax credit they're expecting back, right? And they're supposed to take the number of qualifying children, multiply that by 2,000, and then put the number on the line. Well, the definition of qualifying child on the Form W-4 instructions and on the guide to the employers as well is children up to age 17. That's called qualifying children for the child tax credit. That is now changing. It's going to be children up to age 18. So the instructions, the directions are going to have to change. And yes, this is just for 2021 to answer the question. This changes so far. We don't know what's going to happen in the course of the year, but so far it's just for 2021. And this increase is going to have to be reflected, this age increase is going to have to be reflected on the W-4. In addition, even though the form won't change, you may have employees who are going to be submitting new W-4s, because when they realize that their financial situation is changing, they may want to make adjustments to the withholding. So do be prepared and prepare your HR teams. You might want to bone them up a little bit on the Form W-4. Viventium has a recorded webinar explaining the Form W-4 on our website. It went under major overhaul last year, but if employees are just giving in their forms, they can't give in the old version anymore. They'll say, well, but I've been working for you since 2001. Doesn't matter. If you're giving in a form in 2021, you have to use that whole new revised mini tax Form W-4. So you may want to invite some of your staff or yourself to listen in to our, W-4 explanatory webinar. Now, question here is, if the W-4 is going to have to change due to this age change for child tax credit, is the IRS going to make a new form just for 2021 and then change the 2022 form back if the credit doesn't get extended? The answer is yes. The IRS is going through a lot of hoops and a lot of loops, and they've been revising 941s right and left. Now they may have to start revising W-4s right and left as well. The new W-4, to answer another question, will the new W-4 be in play for 2020 or 2021? The answer is the new W-4 will be in play for 2021 because this dependent age change applies in 2021, meaning to the tax returns that your employees are going to file early in 2022. Now, this is why it gets a little confusing because a lot of people still have their tax returns sitting on their tables, their dining room tables. And of course, you heard we now we have an extension until I believe it's May 17th, filing deadline. So people are saying, oh, does this mean I can claim, I'm entitled to get, $3,600 for my, triplet 3-year-olds or something like that? No, it's not for 2020. This is an expanded tax credit for child tax credit for 2021. So even though we're in the middle of tax season, that's not what these changes are going to affect. It's going to affect the return that'll be filed early next year. Another very family-friendly credit is the expansion of the child care credit. And this is also going to touch on payroll, but I'm going to leave you in suspense. We're not going to talk about that to the end of the webinar because it comes out on the other side of the coin. There are two sides to the child care credit. You as employers are allowed to provide a certain amount of tax-free assistance, often called a DCAP plan, Dependent Care Assistance Plan or Program. And on the other side of the coin, employees are actually able to claim a child tax credit, a child dependent care credit for monies that they pay to care for their children while both spouses are working, limited to certain, limitations of earned income. The expansion of the child credit, right now it's been up to $3,000 per child. And it was phased out at certain levels, maximum of $6,000. There's all kinds of maximums happening there. Now the ARPA comes along and expands the child care credit to $8,000. It also makes it refundable, which means it's not just offsetting your income. It's not just like a deduction against your income. It actually becomes a refundable credit, cash back. $8,000 per child, of course it gets phased out of certain income levels, but that's a big boon to families who pay babysitting, baby care, after school, summer programs, any pre-kindergarten level childcare, and even post-kindergarten, any after-school programs, or summer programs that are needed so that the parents can work. By the way, I didn't mention, but I will mention this $3,600 per child under 6, or $3,000 per child over 6 up till age 18. It's refundable, fully refundable. It's not like the way it was pre-ARPA. $2,000 you could apply against your taxes, but you would have to, if you didn't have tax, you could just get $1,400 per child. Here you get the full amount refundable. Even if someone has zero tax liability, they would still get this money back. So it's a big help and a boost. It's really, really aimed at reducing child poverty. That was one of President Biden's goals in this legislation, as I'm sure you've read. The last non-payroll provision that I want to mention is that the earned income credit for workers who fall within certain earning levels has also been expanded, and is now intended to provide greater incentive for people who are the lower side but working earners. So that has been extended as well. That no longer affects payroll. If you'll remember, there used to be an advanced earned income credit that would have affected us. So that's off the picture. So I'm just mentioning it. What's interesting though is that the law provides for an advanced child tax credit, this $3,600 or $3,000 child tax credit. The law says the provision has to be made to get this money to taxpayers prospectively. They shouldn't have to wait till, as I was saying, till they file their 2022 return to get the money. They'll report it on their 2021 return filed in 2022. They'll report it on their 2021 return early in 2022, but there will be provisions for them to get the money early. Now, as soon as Congress says provisions for taxpayers to get money early, what's the first thought that pops into your mind? Uh-oh, is it going to go through payroll? Are they going to turn an advanced child tax credit into some type of an advanced payroll child tax credit? We don't know yet. We have to wait and see what the IRS is going to do with all of this. Or will it just work like the stimulus? They'll just, start sending people money if they had child tax credit last year. We really, really don't know. Now, I do see, and I have to apologize because I see there are a lot of questions regarding child tax credit and some of these other credits. And I really want to stress that these are non-payroll provisions. They're basically out of the scope of what we're here to talk about today and out of the scope of Viventium as an HCM provider. The only reason I mentioned them was because I just thought you couldn't talk about ARPA without saying something about them, and because there are some, payroll angles to them, the change to the W-4, potential advanced credits on the 941, et cetera. But I'm not going to get into details now. I would direct you to speak to your own tax preparers or tax professionals regarding this. I want to move on to our next circle, which we're really going to orbit around today, and that is the HCM-related provisions in ARPA. And let's look at them high level, and then we're going to drill down and talk about them in detail. So first of all, probably foremost in everybody's mind is the extension and the expansion of the ERC, the Employee Retention Credit. It's being extended, and in a certain sense, it's being expanded, which is a benefit to employers. We're going to talk about that. There's an extension of FFCRA credits, and yet there is a restriction. And I think you may have seen in the billing of this webinar that there is a very, very big pitfall here that could disqualify many employers, probably many of our participants, from claiming FFCRA going forward. It's important for us to know what that is. PPP didn't fail to make its appearance in ARPA. It's there, and we're being given additional funding, additional eligibility. No extension to the program was mandated in law, although I'm sure you heard that the House passed that. It's making its way to the Senate now. And we'll discuss the impact, or rather the non-impact, on payroll loan applications, PPP loan applications, and PPP forgiveness. There will be an increased, that's an increased child assistance tax-free benefit. We'll talk about that in detail. There is a new restaurant forgivable SBA program, and apparently it won't even be a loan. Apparently it will be a grant program. There is a COBRA refundable tax credit that will affect mostly our self-insured employers, but we're going to talk about that. And surprisingly, or not surprisingly, but there are no changes to the Social Security deferral programs, meaning there is no extension of the employer deferral nor the employee deferral. Employers still have to pay back their Social Security in 2 installments, except it's not December 31st, it's January 3rd of 2022 and January 3rd of 2023. They moved it off by a couple, in 2021, they moved it off just because of the way the calendar came out, and then they just decided to keep it the same for simplicity purposes. So it's your deferred employer Social Security is due in 2 equal installments. You can always pay it earlier if you want, but at least half of it has to be paid by January 3, 2022, and the other 50% by January 3, 2023. Talk about planning ahead. Okay, so that's basically all that we're going to be talking about in today's webinar. Let's start with the employee retention credit. Under pre-ARPA, before ARPA, the employee retention credit was set to expire on June 30th, 2021. In other words, it had been extended by former President Trump. It had been extended for the first 2 quarters of 2021. It was even expanded. And now comes ARPA and says we're going to do it for the whole 2021. Basically, it's a 6-month extension. Instead of ending at the end of June, end of 2nd quarter, it's going to end at the end of December, the end of the 4th quarter. One point I want to mention that I haven't heard enough that our clients or prospects are asking about, which concerns me, which makes me think that people aren't aware of this provision. And that is, you know how you can use Form 7200 to get your credits early instead of waiting to the end of the quarter to get them on the 941? You know, if you had extra credits that you didn't have taxes to offset against. By the way, if any of this, what I'm saying, is not so clear to you, what am I talking about? Advanced credits, 7200, you know, offsets, that's all covered in earlier webinars on the Viventium website that explain the provisions of ERC or some of the other credits. So I'm already starting here assuming that we all have a working knowledge of ERC. So you were entitled, if you didn't have enough tax to offset your credits against, you were entitled to either get those credits on the 941 at the end of the quarter, or in order to get, you know, funds over to employers more quickly, to fax a form. This was the only time that the IRS was accepting, you know, employer tax forms by fax. Fax a form called the 7200 to the IRS to claim advanced credits. And those advanced credits would be sent to you, checks mailed to you by the IRS. I'm sure some of you have been receiving them. There is a restriction, and that is that now going forward, ever since December 27th, in other words, the 2021 ERC, you can only get those advanced credits if you have less than 500 employees, without getting into the technicalities of, are they calculating full-time, part-time, full-time equivalents. But you know, for further details, if you're with Viventium, we can certainly reach out to us, and if you want to, you know, discuss that with your tax professionals. But just very high level, it's for only if you have less than 500 employees can you use the 7200, and you can't claim any credit that's more. The amount of the credit can only be up to 70% of your 2019 average quarterly wage. Now, that doesn't mean, and I want to stress, that doesn't mean that you don't get these credits. If you have 501 employees, you're not going to get ERC. I did not say that. What I would say is you will get them, but you will have to wait to file the 941. Again, those of you who are with Viventium, we do it for you automatically. It will be on your 941. It's only you won't be able to hurry up and get them sooner. Okay. For those of you who are asking for more details about this, reach out to your dedicated customer client services team and ask them that you need some compliance information, just as an aside there. Now, the credit on December 27th by the consolidated, the consolidated act was signed by the president at that time on December 27th, expanded the credit. It used to be 50% in 2020, 50% of what you pay to keep your employees on retention. It's now 70%. That will continue. The ERC will continue to be a 70% of wage credit for the entire 2021. The threshold as to who could get credit, even if the employees were actually working, was only 100 employees in 2020, meaning if you had employees who were working and you wanted to keep on paying them, the Department of Treasury, the government would subsidize up to 50% of that wage, even if they were actually working for you, but you had to have had less than 100 employees. Now, the threshold was raised on December 27th. It was raised to 500, and it continues to be 500. So that's good news that even we understand that you'll get a credit if you pay people who aren't working, but you can still get the credit if you pay people who are working, as long as you have less than 500 employees. And of course, you meet all the other qualifications due to the pandemic. The wage limit, again, stays as it was changed by the Consolidated Act. Consolidated Appropriations Act. It was raised to $10,000 per quarter. So it'll be that way for third and fourth quarter of 21 also. In 2020, it was only $10,000 for the year. So if we do a little bit of math together, that means the maximum credit for each quarter of 2021 is $7,000, right? 70% of the $10,000 quarterly for each employee. For each employee, potentially, you can get $7,000 a quarter, which means $28,000 for the year. And if we compare that looking back to 2020, the most you could have gotten for the whole year, or at least from March 12th when it became effective, right, was only $5,000 for an employee. It was 50% of $10,000 for the year. So compare a $10,000 credit, which has been more than doubled, almost trebled for 2021. So ERC is like the next PPP. It's like the next big thing that employers really need to be focusing on and figuring out how they can make it work for them. And there's been a new provision in ARPA that what if you weren't in business at the beginning of the pandemic? What if you weren't in business on February 15th? Before that, you really weren't able to get the credit. Now, startups are eligible for the credit, but the total credit for them is going to be limited for all their employees together to $50,000 a quarter. That's just the new law. Those of you who may be thinking about, well, what about in 2020 when I didn't claim the credit because I had a PPP loan? Well, we know that in the Consolidated Appropriations Act, the provision was that even if you got a PPP loan, you can still now claim the employee retention credit. That was big news. And the IRS considered some special provisions to make it easier, but in the end, they basically just said, well, yeah, if you want to go back now and get those credits, you really have to go back and amend all or at least your second, third, and fourth quarter 941s. You really can't amend a 941. It's called a corrected 941. A 941X has to be filed. Again, those of you with Viventium, if you haven't spoken to your team about this and you know that you're eligible for retro credits, please do. That's just a best practice that for those of you who are with other providers or using internal software, you just want to make sure that you have a 941X capability because there are large financial benefits to going back and amending and getting those retroactive credits, even if you had a PPP loan. Just to mention the caution that we stressed in the last time we spoke about the Consolidated Appropriations Act, I'm just going to call it the CAA. If you do go back and amend, or even going forward into 2021, any wages for which you get a retention credit, you can't claim on your PPP forgiveness form. It would be double dipping, right? The retention credit means the government's paying 50% of those wages. You can't, or 70% of those wages. You cannot go back and claim those or go forward in any way, shape, or form, claim those as PPP compensation, PPP costs. And similarly, any wages that you've already used for PPP costs, you can't go back and claim employee retention on. However, if you had an employee who maxed out of retention, like you already went through the full 10,000 for them, then going forward, the wages that you didn't claim, even though you used that employee, it doesn't just disqualify those employee wages forever. So again, if somebody cleared $10,000 in the third quarter of 2020, then the entire fourth quarter, which you're not getting retention credit for, would be eligible for PPP forgiveness. And just to remind you, the credits going back in 2020 go under the old rules, even though you might be amending now. And yes, to answer your question, Viventium will file 941Xs for our clients, but they have to be requested as part of an amendment process. It's not automatic, so the client does have to request it. If you go back and amend, those credits are going to be under the old rules. It's going to be only up to $5,000 per employee. It's only going forward into 2021 that it's $7,000 a quarter per employee, up to $28,000. Now, in addition to this extension and expansion of the ERC, there's something very, very tricky. And I would say this slide is probably the hardest slide in our webinar, and we're going to see it twice. We're going to see it about the employee retention credit, and we're going to see something very similar about the FFCRA credits. So here it is, and this is really what makes it hard, because you have to understand all the ins and outs of what happened before and now something new. I don't know why Congress is doing this. I have a theory, which I'll share with you, but first let's talk about what it is. When we talk about employee retention credit, there are two different eras. There is 2020 and first and second quarters of 2021. That was pre-ARPA. And then there is third and fourth quarter of 2021 post-ARPA. Pre-ARPA, how did you get your employee retention credit? What do you have to do to get your employee retention credit? Well, you could offset your federal tax deposits. First, you would offset those credits against your employer Social Security liability. That's what the IRS called a non-refundable credit. If you look at your 941s, right, there's a section non-refundable credits and refundable. This is a deviation from the traditional English meaning of the word refundable and non-refundable. Usually we think of refundable meaning something you'll get back, and non-refundable something you won't get back. Well, that's not what it means. It's kind of like in the tradition of debit and credit. Debit usually sounds like something bad, and credit usually sounds like something good. Well, you know, in accounting, the joke with the left drawer accountant who had opened, came to retire after 40 years and came in, and his work staff said to him, "Why do you come into your office and open your left drawer, every morning?" And he said, "Oh, that's very simple." And he opens his drawer and lets them all see for what they've been wondering about for 30 years, 40 years. What does it say there? It says, debit is left and credit is right. So, terms in accountancy don't always, and payroll, if there's such a word, don't always mean what we expect them to mean. So when the IRS calls the non-refundable portion of the credit the amount that gets offset against your Social Security liability, it doesn't mean you're not going to get it back. You will get it back. They're calling it non-refundable for some technical legal reason, which we had explained in an earlier webinar. I don't want to go into now. We're already, have to go a little bit faster in the interest of time. But that's what it was pre-ARPA. First, you offset employer Social Security liability against your credits. And then if you still had additional credits, you were allowed to offset all your other taxes, meaning the employee Social Security, the employee and employer Medicare, and your federal withholding from your employees. That was called the refundable credit. Okay, and then you would claim the excess credit. Let's say you did all that and there was credit left over, you would fax in Form 7200, or if you couldn't or didn't want to, you would just claim the excess credit as a refund on your 941. Okay, that's just review. That's nothing new. What's going to be in third and fourth quarters? So Congress has said that ARPA is extending the ERC, but it's going to be applied against employer Medicare deposits. Remember, that's only 1.45%, not 6.2. Presumably that will be called the non-refundable portion. Now, will the IRS come through again with the same provision and say, oh, okay, well, whatever you can't offset against Medicare, just go ahead and offset against Social Security, employer, and, offset against employee Medicare and offset against federal, just like you did before, just, the mirror image. Will the IRS say that? Will there still be a refundable portion? Well, we don't know yet. I'm not sure if the IRS knows yet. So we have to wait and see what's going to happen. But we do know that there will be, if you do offset against employer Medicare, then the excess presumably will be available to you on Form 941 and presumably through the Form 7200. So remember that this is not going to go into effect for second quarter. Second quarter is still going to be offset against employer Social Security. However, you do need to check with your payroll providers or your software providers and ask, are you set that as of July 1st, 2021, our ERC credits are going to get offset against our Medicare deposits instead of our Social Security deposits? And obviously no one's, ready for that right yet. Maybe next week, check with Viventium. But if you have other providers, you may want to keep following up with them to see when that will be ready. Interesting. Why do I think Congress is doing this? Just a guess. It's not to make our lives miserable. I think it's not politically correct to withdraw funds from Social Security retirement benefits. Medicare, maybe, but maybe it's just sounds a little bit better. It sounds like, well, it's only a 1.45% offset. Yeah, but if you're anyway going to give them the excess credit back, then, it's a little funny. But I think that's my guess. It just sounds a little bit more popular. Maybe there was some discussion about that on the floor. What about PPP or the various SBA programs and the employee retention credit? So I just mentioned a couple minutes ago that actually it's before the CAA, before the Consolidated Appropriations Act, ERC wages could not be claimed as PPP payroll costs. And along came the Consolidated Appropriations Act, and we're doing this real in live time because I like to see things as they are before the Consolidated Appropriations. Along came the Consolidated Appropriations Act and said, well, guess what? You can now claim ERC wages together with a PPP loan, but not the same wages. Oh, that really wasn't a mistake. That really was correct. I know what my intention was there. I'll explain. In the olden days, before the Consolidated Appropriations Act, you couldn't take ERC at all if you had PPP. Came along the CAA and said, yes, you can take ERC with PPP, but just not for the same wages. So that was the only restriction. ARPA added new restrictions, and they said, if you have a PPP loan, well, that's the same. You can't claim the same wages. But if you also got a shuttered venue assistance grant, you can't use those ways, let's say for, theaters, movie theaters, entertainment, you can't use the same employee wages both for your shuttered venue assistance and for your ERC. It's one or the other. And ARPA created a new program called the Restaurant Revitalization Grant, which we'll talk about a little bit at the end of the webinar. And again, came along ARPA and said, you can't use the same wages that you're going to count as restaurant payroll costs for your grant. You cannot also get a retention credit. And, fair is fair. If the government's paying your payroll or subsidizing a portion of your payroll, we're really not going to expect them to allow you to double dip there. So they don't. Okay, that's as far as the employee retention credit. That was the easy part. Sorry to tell you. When we get to the extension of the FFCRA, it gets harder. And again, for those of you who joined us in progress, this webinar is being recorded, so you'll be able to re-listen and review it. There's just so much information packed into it. And I do want to try to respect everybody's time and finish at the top of the hour. I'm aiming to do that. The FFCRA expansion. So they also got the FFCRA credits, that's the paid leave credits, also got a 6 months extension. Problem is, it's a different 6 months because remember, under the CAA, FFCRA was set to expire at the end of March, only for first quarter. So a 6 month extension carries us only through September, second and third quarters, whereas the employee retention credit had been set to expire at the end of June 30, so the 6 month extension carried us through the end of December. So we're really not in parallel. We're kind of, imbalanced in terms of when FFCRA is expiring compared to when the employee retention credit is expiring. And it's really not the fault of ARPA, it's really the fault of the CAA that put, unbalanced expiration dates, but we're suffering from that now. So not only is the credit extended, but the reasons that you can take leave have been expanded. We'll talk about that soon. There are additional reasons that employees can take leave and that their employers can get credit for paying those leaves. Now, here's something really hard. So let's go slowly here. Before ARPA, meaning the entire 2020 and the first quarter of 2021, the credit was for paid leave that you, the employer, paid based on these reasons. It was also for associated health care costs that went along with if you continued paying the employee's health insurance during the time they were on FFCRA leave. And it was also for the employer's share of Medicare on those wages. Now, post-ARPA, in second and third quarters, the credit will be for the leave you pay, qualified health, the employer's share of Medicare, and the employer's share of Social Security. Because the wages that you're paying, the paid leave that you're paying, is subject to employer Social Security. It hadn't been in 2020. It hadn't been subject to employer Social Security, but it now became subject. In other words, this is something you want to just make sure that your software supports. Viventium does, of course. But the wages are subject now to employer Social Security. So since they're subject, in order to give the employer the benefit of the credit, we allow them to include this employer Social Security tax that they paid on these paid leave wages. We allow them to include that in the credit. So in other words, the credit is now going to include 4 things instead of 3 things. Okay. Do you have to pay FFCRA leave? The answer is no. Paying the leave remains voluntary. If you pay, you get the credit if you qualify otherwise. And if you don't pay, you don't get it, but it's not like in 2020 where you had to pay the leave and so you could get the credit. Here, if you choose to pay it, you get the credit up to the applicable limits. The limits are staying the same for self-care, $5,110 per employee. For other care, $2,000 per employee. However, for family leave, right, that was like the 10-week leave, it's going up. You can pay up to $12,000 of family leave and still get credit for it. And those limits are being reset for the second and third quarters of 2021. What does that mean? I'm going to show you a chart in a minute, a little table. We're going to see what that means. And now the restriction. You cannot take the FFCRA credit in second or third quarters of 2021 if your plan favors highly compensated employees, full-time employees, or employees based on their tenure. Now, you and I know that most paid leave programs say, well, you have to be working here at least a year, or you have to work at least a certain, at least 40 hours, at least you have to be full-time in order to, and of course there may be some paid leave plans that favor HCEs as well. Well, if that's what your plan looks like, then you're not going to be able to take the FFCRA credit in the second or third quarter of 2021, unless, of course, you make some type of a plan modification, which is, again, something you have to do in coordination with your benefits consultant, your third-party administrators, your tax advisors. But this is big. This is really, really big because most paid leave programs, kind of work around full-time status or, tenure status, at least being a year, 18 months, whatever the case may be. So you really need to sit down if you have more than one plan, more than one location, decentralized, you want to really review all these plans and make sure that the credits that you want to take, you're really entitled to take, or if any modifications need to be done. What about those limits? How does this whole limit thing work in 2021? Well, I will say here, we're waiting for the IRS. The chart that I'm presenting to you here is based on the careful reading that Viventium's compliance resources were able to make of the law, but it's not clear yet what the IRS is going to do. So this is preliminary. There's 3 types of limits. If you took off time, if an employee took off time to care for themselves due to the pandemic, the limit was $5,110, and that limit was applied to 2020 and Q1 of 2021 combined. And this is like the IRS breaking its own rules, kind of, because usually limits don't cross years, but they said take whatever you paid in the entire 2020 and also combine that with what you paid in Q1 2021, and that entire thing can't exceed $5,110. That means if you had already paid $5,110 to an employee for self-care leave in 2020, you weren't entitled to any additional credit in Q1, even if you paid them additional leave. An important piece of information. For Q2 and 3, that same $5,110 will presumably be applied. We don't know if the IRS is going to prorate it for 2 quarters. We have to wait and see. I can't speak to that yet. But the basic limit is going to be $51.10 for quarter 2 and quarter 3. Another $51.10. In other words, even if you already paid out $51.10, you can do it again for each employee for quarters 2 and 3. Similar idea for other care when someone's taking off time to care for someone else who's in quarantine or, you know, any of those other reasons. That's still $2,000. But again, 2021 couples up with quarter 1. I'm sorry, 2021 quarter 1 couples up with 2020. And quarters 2 and 3 of 2021 are coupled up together. And the family leave, again, it's just mind-boggling that Congress did this. Family leave, you know, it was going to be $10,000, 10 weeks. Well, they've increased that limit to $12,000 for quarters 2 and 3, but they're keeping the daily limit at $200. So it sounds like, you know, the amount of time that you're going to be paying them for is going to be increasing. You can't pay more and get credit for more than $200 per day, but they are increasing the overall limit to $12,000, which sounds more like they're expecting you to pay leave for a longer period. So a lot of you know, questions there, and of course it's all going to depend on how the IRS in practice is going to implement this. What are the new reasons that you can take? We said they expanded, they had added some reasons. Well, the old reasons were self-care meant you were taking off time because you were in quarantine due to a government order, or number 2, your healthcare provider had advised you to self-quarantine, or number 3, you were symptomatic and awaiting a diagnosis. That was called self-care. That has been expanded now for 3 additional reasons. An employee who takes time off can get now their sick leave paid by their employer, and their employer can get a credit if they take time off for getting a vaccine, for recovering from the results of the vaccine side effects, or if they are seeking or awaiting the results of a test because their employer has requested it or because they've been exposed. So that means even if they're asymptomatic, but they're waiting for results of a test or diagnosis. Those are 3 new reasons that you can take the self-care. The reasons for other care stay the same, but the reasons for family leave are also being expanded. You can now get family leave, which was originally the 10 weeks. You can now get family leave for all the same reasons that you can get sick leave for, meaning you can take off now 10 weeks for the employee quarantines or the symptomatic awaiting diagnosis or caring for another individual. It used to be there was only one reason you could take family leave. You remember? It was only if you were caring for a child whose school was closed or place of care was closed due to the pandemic. Now they've said, forget about that going forward, meaning second and third quarters only, not first quarter, but second and third quarters only. Your employees can take time off for any of the reasons for the full family leave of 10 weeks, which essentially makes it a full 12 weeks because you have the 2 weeks under the sick leave and another 10 weeks under the family leave. So that was a big expansion and flexibility to employees. And this slide should look a little bit familiar because this was the one that I said was such a hard slide. This was the one we spoke about with the employee retention credit. The same change about offsetting against Social Security as opposed to Medicare, or as Medicare as opposed to Social Security, the same thing they did to the ERC, they did to FFCRA, except the dates are different. For FFCRA, for 2020 and first quarter of 2021, your deposits get offset against the Social Security liability. That's the non-refundable portion. For quarters 2 and 3 of 2021, your FFCRA credits get offset against Medicare. And again, we don't know how or what the refundable portion is going to look like. We are pending IRS guidance on that. Okay, let's wrap things up in the little bit of time we have left, and hopefully I see there's copious questions here, so hopefully we're heading to a good place. By the way, I want to direct you, those of you who are Viventium clients, I want to direct you please to visit the VCUC, the Viventium Coronavirus Update Center. There's a lot more resources there, including blogs. If those of you want to take a look at our ARPA blog, there's part 1 was published already, and part 2, which is upcoming, I really encourage everyone to take a look at because, and I believe this will be available to non-clients as well, or not yet clients, I like to call you, not yet clients as well. Our part 2 blog has an amazing comparison chart that's going to be coming out probably either today or tomorrow, has an amazing comparison chart between what FFCRA used to be and what it's becoming, what the ERC used to be and what it's becoming. And it just puts everything side by side and really great to look at. Okay, so now let's talk about the Paycheck Protection Program of the SBA and what's happening to it. Well, first of all, it's getting richer. It's getting more funding. It's getting $7.25 billion more to provide assistance to employers out there. And remember, one of the main targets of this program has been the smaller businesses, women and minority-owned businesses. The SBA designated 14 days just for the smaller, employers to get their share of the funding. PPP expands the types of entities that are eligible, additional nonprofit media entities. Media entities are going to be eligible. But thankfully, there are no changes to the loan or forgiveness process. That was one thing that got passed over in this congressional act. No additional SBA forms or types of forgiveness. Whatever was done in the CAA is going to stay. That means you can have any time between 8 or 24 weeks of a covered period. You decide 8, 9, 10, 11, 12, all the way up to 24, and some other provisions that we spoke about in earlier webinars. Now, one of the big questions in everyone's mind is, okay, we got our tax day deferral. Are we going to get a deadline to apply for PPP? Now, why is this especially important? If you're still on your first draw and you anticipate using up your first draw loans after March 31st, and you would love to be able to get a second draw loan as well, you would really need it. Right now you can't because the program closes on March 31st. There's been a lot of pressure on the SBA, or actually on Congress, to do something legislatively that will extend that deadline, especially because SBA was having certain issues with its system. There were some problems in the loan application process. I know for one, the American Institute of CPAs, the AICPA, a very reputable organization, had sent letters to Congress urging them to extend the deadline. ARPA didn't do it. Congress, did not put it in there, no extension. But interestingly, the Federal Reserve Bank has said that they're going to support lender liquidity through June 30th. So they're all geared up. And those of you who want to see the press release, I put a link for it. You'll see it when you get the slides. The Fed is all geared up to provide that liquidity to banks to make sure they have the funds they need to grant these loans. And just 2 days ago, the House passed the extension overwhelmingly, like a vote of 415 to, I don't know, 2 or 3 or something like that. Really overwhelmingly passed it. Now we're waiting for the Senate. And what the House passed was an extension till March 31st, an additional 2 months for employers to get in either on a first draw or on a second draw. So that may be good news, and check back the Viventium site frequently, and keep yourselves up to date about this if it's relevant to you. What about the DCAP program? So we mentioned on the non-payroll provisions that individual taxpayers who pay babysitting expenses are going to be able to get up to $8,000 refundable per child for the expenses that they paid. What effect does it have on the other side of the coin now when we look at it from the employer point of view? So you were able to provide up to $5,000 of DCAP assistance to your employees, non-tax. The employee would not be taxed on it. And that's reported, all the DCAP benefits are reported in box 10 of the W-2, and only the taxable portion over and above $5,000 would filter through to box 1. So as a benefit, ARPA extended or increased that $5,000 threshold to $10,500. I shouldn't say threshold, I should say cap. The DCAP cap, and again, this is 2021 only, the DCAP cap is $10,500. You can provide up to $10,500 to your employees or they can defer in their part of their cafeteria plan, perhaps, if that's how you have it set up. Up to $10,500 with no tax consequences. So now you may want to work with your benefits administrator to revise your plan documentation summaries. You definitely need to revise your system reporting and taxation parameters, because let's say you decide we're not going to allow employees to go back. We don't want to have any retroactive elections or increases. We're just going to keep it at a total of 5,000, contribution, and anything above that, we're just going to continue reporting in box 1. So that would be non-compliant. There's no requirement to revise your plan, but up to $10,500, you may not report, you're not allowed to report as taxable income in box 1. So you're going to need to revise your system reporting, or of course check with your providers. Viventium, of course, will be supporting this. Those of you not with Viventium, you want to make sure that your providers or your software is doing this for you. Your systems will need to be revised to allow up to $10,500 in a DCAP program before any type of tax consequence. That's make sure your taxation parameters are all updated, and of course the amount that's going to get included, the amount of box 10 that's going to get included in box 1 will also have to be revised accordingly. For the restaurants among us, one of the hardest hit segments of the economy, SBA has been charged with creating a restaurant revitalization grant, and that will include $28.6 billion in funding. There is no deadline for entering this program. They say till the money gets used up. I think they were afraid to put a deadline on it. And the language of Congress has been grant, not loan, which presumably means that there will not be an application, a loan application, nor will there be a loan forgiveness process. The way it seems right now, again, we haven't seen the SBA guidance yet, but in accordance with what the intent of Congress seems to be, it's just going to be a one-way street. It's just going to be a grant of up to $10 million per establishment. Well, for certain, they'll be able to get up to $5 million per location. It can be used for payroll, rent, utilities, supplier costs, of course, their food and beverage expenditures, other paid sick leave even, and other essential expenses. So this is meant to really boost a lot of needed into the restaurant industry. I saw we had a question before on the COBRA credit, and since we are coming up on the top of the hour, we're going to speak about that a bit. There were certain individuals who lost their COBRA coverage due to the pandemic. They were terminated, and this only, by the way, implies to involuntary terminates, not voluntary terminates. Employees, and also not for involuntary terminates due to gross misconduct. But someone who was involuntarily terminated and wasn't able to meet their COBRA premium payments due to the pandemic would have lost their coverage, and the dependents would have lost their coverage. Any of those individuals will now get a government subsidy of 100% of their COBRA premiums for quarters 2 and quarter 3 of 2021. In other words, it's going to be a 6-month subsidy. Who's going to pay the subsidy? Well, if you are a self-insured plan, you're going to pay it. If you are a fully insured plan, your insurer will pay it. But really, the federal government will pay it, because the insurer will get a refund for what they pay, and you, as the employer, if you're self-insured, you will be able to get a credit. Here we go again. You will get a credit against your Medicare deposits for the amount that you pay to subsidize these qualified assistance individuals' premiums. Now, again, if this doesn't apply to you, so there's one less complication. But if you are a self-insured plan, you definitely want to be keeping your eye on the IRS guidance, because IRS has been charged with creating a process. And will it go on the 941? Probably, but not necessarily. IRS has been charged with creating a process for claiming excess credits if there's more money than you can offset against Medicare, which there probably will be, because Medicare is only 1.45%. So this is, again, something that you want to check back at the Viventium space frequently, and you want to keep your eye on, and you want to already be raising with your providers to see how they're going to be accommodating this new provision, this new credit. So where's the IRS up to with all of this? Remember, the IRS just postponed, very wisely, I believe, the tax filing deadline. Right now, the IRS's first priority was getting out those advance payments. And right after the law was signed by President Biden on March 11th, the IRS made the following statement on their website on March 12th, basically saying that we're reading it through, and we're going to get the credits, the payments, the stimulus payments out there as soon as possible. Just sit tight. Don't do anything. If you're an individual taxpayer, don't go back and start amending tax returns. And I would assume they would be saying the same thing to employers. Don't do anything yet till we can get guidance out there. We're digesting this, and they repeat it twice in this paragraph. I just put the screenshot there for you to take a look at. The IRS emphasizes they should not file an amended return at this time. This is speaking to individuals, until the IRS issues additional guidance. So really, that's the place that we all are at. Just wait and see what happens. Next steps, well, we're obviously going to need a new version of Form 941 to reflect the extensions. we're going to need IRS guidance if this 7,200 restriction of employers of less than 500 people, is that going to continue for the remainder of 2021? What about offsetting the employee retention credit or the FFCRA against other payroll taxes? You do need to be reviewing your FFCRA policies to make sure that they are not top heavy. We are expecting IRS guidance on the W-2 reporting of FFCRA credits, and of course, keeping our eye out for that potential PPP loan application extension so that those of you who didn't yet get second draw loans, we're waiting to use up your first draw funds, may be able to get them. And unfortunately, we did run a bit over. I apologize, just a wealth of information, so I wasn't able to get to many of the questions that were asked. Those of you who are with Viventium have the advantage that you can just call up your client services team and say, we have a compliance question, can you get us an answer? And I encourage you to do that. And of course, if you'd like to learn more about Viventium, please do visit us at viventium.com. And again, I want to encourage everyone to help us out by answering that brief survey as you exit the webinar. Appreciate your time, attention, participation in today's webinar, and I want to wish you all much success in implementing all of the new provisions that can assist your business as part of ARPA. Have a great day, everyone.